All right, guys, we're about ready to have Chris Mayer, the writer of 100 Baggers. It's a great book. Mo and I both read it. Mo read it twice. It's a great place to look to understand how you can find a company that's going to go from 1 to 100 times your money. There's many routes. Chris wrote a great book. He's got great insight. Check it out right now. Thanks, guys. So, Chris, I basically read your book and walked away thinking to myself, every stock I buy is going to go up 100 times. Was that the takeaway that you wanted me to walk away from that book with?
I think the takeaway I wanted you to walk away with is that it is possible,
Yes.
and it's worth making it a focus, worth making it a goal. Don't mess around with stocks that are going to go up. You think are going to go up 30%, you're going to sell in a year. Think big. Think big.
I think my philosophy on investing as a value investor has changed dramatically in the last 3 years. I used to want to be more of the, original Buffett days of finding situations that were undervalued by X% and then move on. And then I realized how incredibly lazy I am. And I thought to myself, okay, I think the better idea is just to be a little bit more patient, find good companies at, I believe, great prices, and ride them out. Now, that's the reason I liked your book so much, was because it kind of blended this world of let me buy mega caps that are a little mispriced, which is less likely to happen, but let me find smaller companies that have a high return on invested capital. And this was I own a lot of real estate. And the thing I love about real estate, I own a lot of apartment buildings. I love investing them. So I renovate a unit, I get a higher rent, and I compound and compound and compound. And that's why I loved your book so much, because it basically took that premise and did it with companies. Like, what companies were able just to compound on themselves and really, really grow. And I guess my question to you is, when did you have that realization that that was the right way to do it?
Yeah. Well, I wouldn't say right way, because it's
Right.
certainly the
For
old
you,
value way of just buying and then waiting till it gets to intrinsic value and then wash, rinse, repeat. It's definitely doable, and people have done well on it. But I've had that same path you did. I started off Ben Graham, old early Warren Buffett style, trying to buy things at deep discounts, and then when they become more fully priced, you flip it and you go and do it again, find it somewhere else. But as you mentioned, that takes a lot of work. You got to keep looking. You got to, and it's also a tax drag, and it's also hard to do with a lot of money. As you get more and more money,
Yeah.
it's more difficult to constantly find those kinds of ideas. So it was very slow. And I'll tell you, when the light bulb really clicked is when I did the study for the book 100 Baggers, when I did that research. I looked at all those winners from the past, and I realized that, all this, buying and trading that I had been doing, even if I had held things for a year or 2 or 3 or whatever, I would have been better off buying a really great business and just leaving it alone. And how much easier that was as well, which you point out.
True.
I mean, once you do a lot of work on upfront, on the quality of the business itself. But once you're over that hurdle, ride it out, stick with it, and that's where you really make big money, 10 times, 20 times, 50 times, and occasionally, yes, the big 100 bagger.
And it's funny you say that, because you did often talk about it with real estate.
Yeah.
And I think it was, I don't know if it was this book for you, but that's kind of when it started clicking for us about really discussing high ROIC businesses.
That's a great analogy. I mean, that's exactly how it
Yeah.
is. It's a great analogy. Once you start thinking of companies in that same way, that they have certain capital, reinvest, do it again, then you really understand compounding, how it works with businesses. And it takes your focus away from things like that other things some people are so focused on, like price earnings ratio, or what the dividend yield is, or what the chart looks like. And you're more focused on that underlying engine of that business.
What prompted you to start doing that research? Was there like an
good
aha
question.
moment where you were like, okay, I think there's something to this. I'm going to start digging into this. And when you did that, did you have the intention of writing a book about it?
No. So originally, I was like a big time investing nerd. I thought I read every kind of investing book there was, but someone told me about Thomas Phelps's book, 100 to 1. Actually, I first encountered that with Chuck Ockray's speech. He gave a speech called An Investor's Odyssey. You can Google and find it online. Definitely worth reading. And he mentions this book by Thomas Phelps that came out in 1972 called 100 to 1 in the stock market, where Phelps looked at all the stocks that had gone up at least 100 to 1 from like 1932 to when he wrote the book. And so I read that, and I really liked that book. Phelps is a good writer. He's got a lot of quotable lines in there. He's very kind of folksy, and it was just fascinating that they take this little narrow approach to investing and just focus on these companies that really, were tremendous outperformers. So I liked that book. I would quote it to people. I talked about it. And then one time I had a reader who suggested me, said, you should update it. And that was like light bulb. I was like, that's a great idea. So that's how that got started. And I started to think about getting, a database together as far back as I could go at the time with the resources I had, and basically updating Phelps' study.
And how long did that research take you? Like, how much time did you spend researching this book before you even put pen to paper? And then,
yeah, I think it took about 9 months or so.
Oh.
I had time before I started writing it at all. Took a while to actually just get the data, and then kind of scrub it, and we made some decisions along the way, like I took out little like penny miners and things that went from 12 cents to $3 because I was less interested in that kind of idea. I was looking for things that you could maybe see more in the financials that you would have some hope of maybe predicting could get to 100x over time. So that took some time, and then just working through it. There was also some stuff I did in the book, like I went to Middleburg and met with Chuck Ochray, and I interviewed Jason Donville, and there's some other things like that took time. So I would say it was probably 9 months of getting that all together before I even started writing it. And then it probably took another 9 months of writing it, but it wasn't like that was the only thing I was doing. It was just something I was doing kind of nights and weekends when I had time.
Awesome. So one of the hardest parts for, me that I've, if you see the transition for me as a value investor, like you said, the early Buffett days, the Ben Graham, like I was talking about earlier, is, one of the hardest parts is what is the appropriate premium to pay for, you're smiling right now, even hearing that, because, we have a good friend of ours who runs a value fund in Boston, very smart man. And it was funny, one day I'm writing to him about ROIC, and I said, Gary, what's the right premium? And I said, I don't get the math of it. And then he went and explained the math of ROIC. I'm like, no, Gary, I get the math of ROIC. I get that. He wrote back, he's like, yeah, I thought you were a smart guy. I was wondering why I had to explain. Like, no, it's what's that appropriate premium? Like, you look at Buffett. He bought Coca-Cola in 1987. His first transaction was a 30 PE. And he's made 11, 12% on Coca-Cola since 1987, if you include dividends. Mm-hmm. But 30 PE, I mean, that's a lot, you know what I mean? But his thought comment was like, listen, it's Coke. I mean, if they raise their prices 5 cents tomorrow, people are still buying Coke. And I look at these early companies, and the one thing you've done in the book is they seemed expensive as they were compounding, because that's what you have to pay for. You have to pay for that compounding ability. And that's where I'm still in the early stages of my multi-bagger process of saying, okay, but what's the appropriate premium to pay? Because it also depends on where the business is in its cycle. A Monster beverage in 2003 is a lot different than a 38 ROIC Apple today.
Yeah, exactly.
Right? So what have you found? What is your take on that? And please give me some nugget that'll make me go, I have this aha moment, so it makes it a lot easier for me.
You're not alone in that. I think that's a big hurdle for a lot of people, is high quality names like that are often expensive. They look expensive. They carry a premium multiple. And I think, the way to get over that is to calibrate let's just say, taking something simple like price earnings ratio, always calibrate those valuations to the underlying returns on capital. And you'll find the market tends to sort these things out pretty well. And companies that generate high returns on capital have higher PEs than companies that generate lower returns on capital. And so, if you spread it out, one of the things I find helpful sometimes is you put it out on a spreadsheet, or you just know the math in your head that if you compound at 25% at the end of 10 years, that's almost 10 times increase. And suddenly that puts it in perspective. Paying, let's say, 35 times or something today, it's going to be 10x what it is 10 years from now. Then you put some multiple on it, 10 years out, say what it's going to trade for, and then back in what your IRR is. Then you can find out that you can pay quite a bit more than is intuitive with the numbers. But you have to be right about the business. That's why, when I say this to people, I say you have to spend a lot of time on the business, and you have to feel really good. That's why Buffett, he's always talking about moats and competitive advantage, because he's thinking about, can this business generate this high return on capital? Can it do it again and again and again for a decade or 2 decades. And the more assurances you get around that, more comfortable you can feel about paying up. You've probably seen it. Terry Smith is one of the money managers who's done this, where you look at a great business and then you roll back and say, 10 or 20 years ago, what you could have paid and still earned whatever percent. I've done it with some of my own names. I know I looked at Copart was a name I have in the portfolio. And in 20, I think I did it in 2011 to 2021. I think in 2011, it was like, you could have paid 67 times earnings and still made 15% compounded over that decade to 2021. And the stock actually went up like 10x. So, you do that and you start to appreciate how to think about value when it's not just about the multiple, which really compresses your time horizon. It's about thinking out, a decade and what it will look like.
Do you remember when you paid that for Copart, do you remember what your thought was to say, yeah, I'll pay 67 times?
No, I think he was saying, if I understood correctly, Chris, you were saying that if you had gone back.
Oh, if you had gone back.
Yeah,
okay,
because
okay.
Right.
Yeah.
I think at the time, Copart was trading at like 22 or 25 times earnings or something like that in 2011.
Okay.
And from that price, it went up like 10x. But,
Got it, okay.
you could have paid, I think, the math might not be exact. You could have paid up to like 67 times earnings and still made 15% annualized over that decade. So it goes to show you how much room you had. I mean, back then, I remember I didn't buy Copart in 2011 because I was thinking, gosh, it seems expensive at 25 times earnings. I was still operating under that older view. And
do you remember what the ROIC? And do you remember what the ROIC was in 2011 on Copart?
I believe it was around 20, because that was another thing about Copart. When you look at it, it's an incredible. There's not a lot of variation. In fact, it's gotten slightly better over time as it's scaled and it's built in the network. The returns have actually gotten better. It's gotten better with age.
And that's what I love in your book. You're very to the point about, hey, you need the runway. I mean, at the end of the day, to really find a 100-bagger, the monster beverage, you need that runway. Or NVR is a very, very common case study on 100-bagger. In 2000 or 2001, it was, $50 a share. Now it's 5,000. That's a 100-bagger. And in that time, the PE has never been above even like 14 or something. I mean, it's been low double-digit PEs, but they did an incredible job of buying back their shares very cheap. So all of a sudden, even though they've grown tremendously, they haven't grown 100 times in terms of volume and profit, but they've done a good job of buying back shares. So they had a little bit of runway. They still, 6-7x their revenue. But the other thing is their stock stayed cheap all those years, and they just kept buying and buying and buying, as opposed to like a Monster Beverage, who had a big runway, small company, high returns on capital, and had a lot of growth left in it. And that's why it was able to compound that way. So 2 different situations, but got the same result, but taking into consideration the high ROIC, and one was buying back shares, the other one just had that long runway of growth.
That's right. I like to say something to 100-baggers. It's a math problem, really. So if you're trying to compound 25% a year for 20 years, there's different ways to get there. You can get there with earnings growth. You can get there partially by, as you say, buying back stock consistently over time. You can get there also with some multiple expansion. So in the book, I talk about the twin engines. You buy something at 15 in the beginning and it trades for 30 at the end. That's 2x just on the multiple. So now you're only asking the earnings go up 50 times. So it's not as big a hurdle.
We just, it's funny, after reading your book, Chris, and I'm not kidding about this, we have a new guy who's starting with us in October. His name is Dalton. And I've literally told him, your job is to find us very small, sub $1 or $2 billion companies that we feel have the ability to compound tremendously to get to the 100-bagger status. Like, we are literally dedicated, but I'm not going to put a lot of money into them, but I don't need to. That's the great part. I can put 0.25% into 1 or 2 of them a year. And as I add more money and over time, and I've actually told him, and I want to hear your opinion on this, I told him whatever we invest in, we're never selling. So we're either riding it to zero or we're riding it all the way up. Because to me, what was that?
Almost a coffee can strategy.
Yeah, the coffee can strategy of, listen, once we find a great business, let it run. And if it goes to zero, it's a 0.25% of our money. I don't care. But if we can find 1 or 2 situations a year that make sense, 10 years later, you had 10 or 20 situations, and all you need is one of them to hit, and all of a sudden you've made up your money many times over. And I just want to hear your opinion on that. If you say, well, Paul, I would look at it this way.
I love that. And Mo brought up, coffee can. That's what I was thinking too when you were talking.
Yeah.
I was like, that's that idea. In fact, I had a reader of mine who actually came and sent me an actual coffee can.
That's great.
And with a little note saying, here's my coffee can portfolio, and you open it up and it's a little spreadsheet in here with all his names. It's a great idea. I thought I gave him good credit for that. But yeah, that's the idea. The coffee can portfolio is you put things in it and you just leave them there. So the outcome depends on what you put in, but it protects you against yourself. That's what I like about it. Because probably one of the biggest obstacles to people making big money in stocks like that is they watch them all the time and then they sell at bad times. Or they sell after they double their money and they think they did great and they sell it and then look back and wow, I used to own Microsoft.
Oh, yeah. I'll get into that in 2 seconds. Mo, you go ahead. Unless you want me to skip my story.
But especially in companies that are sub 2 billion, I mean, those can move. We see them every day. You could see them move 30% in a day and you panic. Nothing fundamentally changed.
Gut-wrenching, yeah. So the biggest mistake I ever made in investing was, and I always tell the story. In fact, I had somebody on Instagram once reach out to me, go, why do you always tell that story? I'm like, because it's so perfect. In 2011, 2012, Microsoft was considered dead. And I was looking at the numbers and I'm like, wait, how are they growing profit 11, 12% a year and their revenue is growing 7 or 8% a year and they're dead? So I bought it around 21. So I think it hit a low of like 11 or 12. I bought it 21 and I valued it around like 50 to 55. Fast forward a year and a half, it hits a few years, it hit 55. I think I sold at 58. And I said, because I had the Warren Buffett approach. Great.
Yeah.
I got my money, move on. Yeah. Now I value, now I'm not willing to buy a Microsoft unless it's like 180 or 200. And I look at that thinking to myself,
Sure.
if I had this mentality back then, I'd be sitting on a 16, 17 bagger already, and it's like, okay, good lesson learned. It sucked, but I didn't understand the power of the ROIC in Microsoft. And of course, other things happened that really allowed them to grow their revenue even faster than I expected them to and their profits. So it is what it is. But like you said, Microsoft was my personal example of son of a bitch.
Yeah.
Can't believe that.
I think everyone's got those.
Yes,
I think everyone's got those stories. And I mean, even Warren Buffett has that story. He tells a story where he owned Disney long ago. And it was, I think, like split adjusted price was like 78 cents or something crazy. Now you look at Disney and you're like, wow. And he did okay when he bought it, but if he had held it, he'd be sitting on, another 100+ bagger. So everyone's got those stories. And I something to say. I wish that I had found that kind of passion for 100 baggers, that sort of way of looking at the world much sooner.
Of course.
Would have had a few of these by now.
Yeah. Mo's got Apple at a basis of 11. What is it? $17 a share.
Yeah.
All right.
I'm happy with
Excellent.
that one. I want to go back to Runway. When looking at some of these smaller companies, how do you look and it's hard to look at a small company and say, yeah, this thing has a pretty extensive runway, because in retrospect, we can always see it. But when you're there looking at it for the first time, what goes through your mind to say, yeah, I think this thing really does have a runway? Are there certain things that you look for?
Yeah. Well, I mean, some things it's easier to imagine than others. So
absolutely,
like a restaurant or retail where they've got 100 locations. Okay, you can imagine they go national, global, right?
Yep.
A beverage company. There's some things easier to imagine than others. But the way I think about it is I've spent a lot of time on that business at first and the engine, and hopefully I also like the management team. Ideally for me, they're founders or they've got a lot of skin in the game, so they're entrepreneurs themselves. Because I've also found that when you invest in great companies with entrepreneurs like that, they're continually surprising you with new things. I mean, we already talked about Apple. Think about how many times Apple has basically created a new market that didn't exist. I mean, you owned Apple before, you couldn't have foreseen that they would create the iPhone. Right? It wasn't there.
I had no idea iPad would be a thing.
Or even Amazon. I remember reading early reports on Amazon, and people would say, well, even if they captured 100% of the book market, it couldn't justify the valuation today. Mm-hmm. It's hard to imagine that they would get into everything else, much less have AWS, which is one of the largest software companies in the world within it. So, you want to give yourself some room for imagination, that the companies can expand into different verticals and new markets. So that helps get to that point too about looking at runway. Mm-hmm. But big markets, and also if it's not a big market itself, then adjacent markets that it would be natural to get into over time. Those are ways to kind of think about runway.
Yeah.
Yeah, I always talk about, I have a friend of mine who's in restaurants, and his brother has a chain of restaurants that are, and I talk about that. I'm like, okay, well, I look at Chipotle, and of course, and they've asked me to talk about it, and I'm not really a restaurant guy, but I look at that going, okay, what's their, I always want to ask them, because they've asked me to talk to them about the numbers, and I feel bad because I just want to look at them just to see what are their ROICs, like what are they investing? And I look at it very simply. I don't even want to hear what's your ROIC. I just want to sit there and say, okay, every new location, what does it cost you? Okay, how long before you get to profitability? And at that point, what's stabilized profit? I don't need to understand the exact metrics of ROIC because I have that business experience of saying, hey, if I invest $1 million in a new location and in 2 years it's generating me $400,000 to the bottom line, you don't need to be a genius to realize that's a really good return. Right?
Those are easier. I like those. Some of them, like I say, they does require some imagination. So like I mentioned Copart before, what they did is they have an online marketplace where they sell salvage cars. But, who's to say that then they couldn't eventually get into selling, more used cars that you can just drive off the lot? And who's to say they can't eventually get into other things that might be on their online platform? So for example, I remember there was a quarterly call not long ago where the CEO dropped that they had $200 million business in yellow iron, tractors and big stuff like that. Or who's to say they can't get online selling motorcycles on their same platform or power boats? And so you start to imagine, how it can kind of go across, and then they're expanding abroad. So yeah, I love the situations you mentioned where you have kind of unit economics of a box, whether it's a retail store, a restaurant, or whatever. But then, there are other kinds of where it requires a little bit more imagination, thinking about near verticals or other markets they can kind of get into.
And I would argue that the Copart situation is probably harder to understand, but probably more profitable if you're correct, as opposed to, a restaurant involves a lot of, different things. Are the areas they're going
Well, they
into
also get a lot of
shifting?
coverage. Everyone understands restaurants, right? So every once in a while you get a concept like Shake Shack, and it trades for or Wingstops, and it trades for huge premiums, right? Because people know about it and they understand it. So that's a challenge too.
Yeah, that's absolutely. So in your portfolio, personally, if you don't mind me asking, not asking for what's in it, do you focus on these situations where you're trying to get the 100 baggers, or do you have some where you sit there and doing what I do, which is a majority into quote unquote,
here's my
20 plus $1 billion companies that are a little mispriced because of perception. That's what I do like about the big companies. It's harder to get the mispricings, of course, but I don't need major mispricings. I don't need to be able to get 20% returns to be happy in those. If I'm happy, if I can get a premium of 1 to 3% over the market, and we do a lot of covered call writing, and that's a very profitable venture for us. But on smaller situations, like, how do you mix your portfolio? Is it 100% I'm going all in on these 100 baggers, or is it a kind of a mix?
It's a mix because more, I think, practical reasons too. It's just not that easy to find the smaller companies.
Of course.
And so I focus more on that engine that we were talking about, 20, 25% kind of compounding. And if I find a company that's got a $20 billion market cap, I'm not going to walk away just for that. So I think I have 11 stocks in portfolio. I think the largest is probably 40 billion now. I didn't buy it at 40, and I probably got another 32 between 30 and 40 billion. Again, I didn't start buying them at that price. And then there's a big drop off, probably 20 billion. And then there's the rest of the portfolio. Most of it's probably in that billion to $10 billion range. And I have one stock sub billion that.
Oh, great.
So yeah, I know, I think anything below 10 billion is a rich area to fish. It doesn't have to be tiny. Yeah. I know in the book I said, I think I wrote 300 million was the market cap. And I often told people if I wrote the book again, I don't know that I would said that, because a lot of people then are kind of dropping their ceilings a little low. You can find some really wonderful businesses that's sitting there at 2 billion or 8 billion market caps that, you shouldn't pass on them just because you have a hard time envisioning getting to 800 billion. yeah, something.
The interesting thing is, I want everybody here, you can buy a $5 billion company and it can go to 20 billion and you still 100 bag if they buy back enough shares. And that's what I want everybody to remember watching this video, is if they're buying back shares properly, you don't need the company to go up 100x for you to make 100x on your money. Look at NVR. Everybody look at NVR. It is the case study. Literally, the business makes 6 or 7 times more profit, or 10 times more maybe today than it did in 2001 or 2002, but it's up 100 times because they just bought back like 90% of the shares.
Very, very important point, actually, because a lot of people talk themselves out of an idea because they can't imagine it being up 100x.
Yeah.
Right.
But like you say, it doesn't have to get there like that.
You're a $20 billion
Buying back
company. It
stock.
doesn't have to go to 2 trillion for you to make 100x. It can go to
Exactly.
100 billion, but they can grow their revenue, but they can grow their profit 20x in 20 years. And all of a sudden you got yourself a 100-bagger like that.
Yeah.
Chris, part of your process, especially looking at these smaller companies, how nitty gritty do you get into the numbers? Do you contact investor relations, et cetera? Is that the type? That's not the type of investors that we necessarily are. But we have a friend,
Yeah,
our
I was
friend
gonna
Gary.
say.
I mean, he is walking through factories.
Right. Yeah. So, yeah, I mean, the retail and regular, everyday investors aren't going to be able to do that level of research. But yeah, for me, I'm meeting management teams, and so for the smallest company that I have in the portfolio, I've met the team a couple different times. I think I know everybody in their HQ by now.
Wow.
I've visited, walked through factories, visited sites, talked to board members. I mean, talked to people who used to work there. So I spent a lot of time trying to get that 360 view, trying to understand the culture of the business and people there and all that. I spent a lot of time there.
That's great.
Yeah.
So what did you do before you wrote this book? Because I don't really know what your history is in your career. Like when you said I wrote it on the weekends and at nights, what were you doing during the day?
Yeah. I had kind of a varied career in finance. So right out of school, I worked commercial banking as a lender. So, lending money to small and medium businesses, local distributors, lines of credit, real estate deals, all kinds of stuff. But I always had this passion for investing. So I started a newsletter just as a nights and weekends kind of project, just for fun. And I would write it. And eventually I made a deal with a publisher in Baltimore. So after about 10 years in banking, then I wrote the newsletter full time and traveled all over the world. Wrote my books then. It was great time to do that. And then I worked for the publisher that I had. The company was owned by the Bonner family. And so I worked for their family office for a couple of years in 2016, and then 2016, 17, 18, and then 2019 started the fund with the backing of the Bonner family. They seeded it. And so that's what I've been doing ever since.
Awesome. How big's your fund?
Now it's about 135 million assets now.
Oh, good for
Pretty
you.
good size. Yeah.
That's great. That's awesome.
So I've heard and read that you like Constellation Software. That's one of your companies. So they're serial acquirers, it seems. When you're looking at mergers and acquisitions, and we did a video yesterday, I think it was yesterday, on AT&T, and they are a company that acquires everything in sight, and it never goes well for them.
Right.
A company that does a lot of acquisitions, how do you determine that those are good acquisitions, that they're going to be beneficial to the business in the long term?
Yeah, great question. I mean, I think acquisitions probably get poor press. There's a great book called Deals from Hell, and the first couple of chapters in that book kind of summarize and lay out a lot of research on M&A, so I'd recommend that. There's some clues, M&A deals that work versus don't work. So smaller deals that are more almost programmatic, like they're continually do these small acquisitions, tend to work better than the big splashy acquisitions. So some companies like Constellation Software, I mean, they've got it down to a process. They're looking very specifically at vertical market software companies. They have a tight box of what they're looking for in terms of figures and numbers, and they've got a vast database. Since they own a bunch of them, they know what these look like. They know how to run them, and that works very well. Versus companies that are trying to buy for different reasons. They're not regular acquirers, or they use a lot of debt to acquire. That's sometimes bad. If they issue shares to do acquisitions, that's can be another red flag. So there's a lot to it, but that's some of the points.
Are you a big person that researches into the CEO to kind of see what their background is, where they? Because when we had Professor Aswath from NYU on last week or 2 weeks ago, and I asked him the same question, like what he looks for in a CEO. what characteristics, because a lot of CEOs now, especially in the bigger companies, they started out as salespeople and they worked their way up, and they're terrible capital allocators because they have no idea what they're doing.
Right.
How do you look at them? And does it play big into your process of selecting a company to buy?
It does. I mean, the first pass would be, I talked about it earlier, the skin in the game. So first thing is I like them to own a good amount of stock themselves. So I tend to invest with founders or founder families. So another company I've had in the portfolio for a long time, Brown and Brown. Powell Brown's the CEO, and he's the grandson of the founder. And he's actually, it's unusual to find third generation like that, but he's an excellent CEO. So there's a lot of things I look at. Besides that, I mean, sometimes visiting them, you get little clues, whether their office space is extravagant or not, kind of how they treat people, talking to people who work there, getting a sense for things like employee turnover gives you a sense sometimes for quality of management, depends. But yeah, I mean, when I talk to a CEO, a lot of times I'm not asking him so many specific questions about the business. I'm asking him more philosophical questions about how they think about business. What do they think about as success? How they motivate, incentivize people, what they think the incentive should be, and those kind of things. Try to find good alignment between those ideas and what I think as a shareholder. Mm-hmm. But I agree. Most of CEOs, they're there because they're charming people. They were salespeople. They are salespeople, and so you can also get charmed as investors. You have to watch.
That's my hardest part about investing in larger companies is that I feel like they go for the splashy CEO and they go for the guy who's going to be in front of the room with his turtleneck on. I'm not saying that about Steve Jobs, but the cool guy. And I'm like, and then I hear things like, oh, great news. This company is selling for 84 times earnings and they're buying back. They just announced a $20 billion buyback. And I just go, okay, sounds good.
Yeah,
right.
Awesome. So those are the things that I struggle with in larger companies. But like you said, if it's a small company, you want a large chunk of their net worth tied up in the business. You want a big, that's one of the things we look for in really small companies, saying, hey, is this CEO worth 40 million? Yes. Okay. Is 35 that 40 million in stock in the company? Yes. Is the company a $300 million company? Yes. Okay. There's a lot of skin in the game there. That guy's going to make absolutely the best decisions he thinks are going to drive the value of the business.
Right.
Yeah, that's what I like. I like to have, if the CEO doesn't just have to all be in the CEO hands, but it could be like there's a family there. There could be, 3 or 4 kind of large holders and they're on the board. So, you're a passive outside minority investor. You're not there to watch them all the time. And you want to have someone who is sort of watching the chicken coop for you and someone who's aligned with you because they own a lot of stock. And that really cures a lot of the ills with it.
And then there's the Warren Buffett quote: "We want to buy businesses that are so simple that an idiot can run it, because eventually an idiot will run it." You know what I mean? It's it's funny because I hear him talk about management, and then I hear him say things like that, and I go, okay, well, I get that, but it kind of seems like it's, maybe I'm looking at it wrong, but it kind of seems like it's from both ends of the mouth. It's like, we love management, and then, but we also want a really simple business because eventually an idiot will run it. I'm like, well, if it's a really simple business, maybe the idiot's running it right now. I don't know.
True.
Everybody attacks Steve Ballmer, and I don't know the history of Microsoft from 01 to 11, to 16 whenever Ballmer left, but everybody attacked Steve Ballmer, and I think it was a reflection of where the stock price went. I don't think the stock price went down because of Steve Ballmer. I think the stock price went. Now, again, I've heard stories about management and how they did, what's it called, reviews, employee reviews, and you kind of sit there and go, oh, that's a little weird, but I always defend, and just like with Jack Welch, I always say, well, was Jack Welch really that great? Because he happened to leave on September 10th, 2001, and since then, GE has done terrible, but I have a hard time believing it's because of September 10th, 2001, all of a sudden, Jeffrey Immelt was just the worst CEO of all time.
It's hard to judge those things. It's kind of like, with like sports, certain managers take over and then they do well or not. It was really their fault entirely, or, so it's the same thing with CEOs, or it's not easy to evaluate them really fairly.
And I'll be honest with you, that's why the one thing I focus on CEOs for is, what are they doing with the money?
Yeah. That's
what I want to hear. That's what I want to see. And even then, I'm a fan of Alibaba stock. And the reason I like it, part of the reason is the stock went from 310 to 58 and like sub 120, they're like, okay, we're going to do buybacks. I'm like, good. Before then they weren't talking about buybacks. There was no reference of buybacks. I was like, okay, these guys, and a lot of Chinese companies don't buy back a lot of stock. So for them to do that, I was like, okay, they good time to bring that in and bring the conversation in to buy back what I perceive to be cheap shares. Again, I could be wrong, and there's a lot of other issues to worry about with Alibaba, but I thought to myself, okay, these guys believe in the business. They're going to take their capital and buy back cheaper shares, and they weren't announcing it at $3.20 a share. They were announcing it at $1.50 or whatever it was.
Yeah, one thing I would say is you don't want to overweight manager to the extent where you're willing to get involved in a subpar business because you think the management's great.
Agreed, 100%.
Yeah, very, very good point.
Yes. Warren Buffett said that many times. He says, listen, when we have smart managers enter bad businesses, it's usually the bad business that wins. That's a quote he's very common for saying. It's like, okay, yeah, it's true. You could take the best CEO in the world and go put him in charge of Ford. It's going to be a tough go at it because it's a very capital intensive, low return business. It's just the way it is. Airline, have her run an airline. It's like, okay,
it's going to be hard.
It's always a hard thing to go.
Agreed.
But so anyhow, so we have we have our software on our site and everythingmoney.com, and we have a lot of users who write questions. And one of them was, what's your biggest multi-bagger to date? And do you still own it?
My biggest multi-bagger to date? Well, I think the biggest winner I've had was back in that prior iteration. And it was like in a little oil and gas company that went up. It went from around $2 to 75.
Wow.
But I was out of it by, I hit like 50. So, but that was in an early iteration when I was doing that kind of stuff and buying things. With the newer approach, I haven't been at it long enough to have a really big multi-bagger. Probably the biggest winner that I still have in a portfolio now might be Copart. I mean, I was buying that pre-split adjusted at like the 20s, and it's hit 90 something.
That's great.
A few that have tripled, but.
Well, but we're still in the early stages.
20 years, hopefully I'll have my 100-bagger.
Yeah. So, somebody asked a question here, and I'm going to answer it because I'm pretty sure I know the answer. What do you think is more important regarding 100-baggers, your entry price point or the time you hold the stock? I think it's pretty obvious it's time you hold the stock. You're not going to, you have to let that thing compound. And it's amazing how fast it compounds. That's really the key. And I really like, what makes the most sense to me, I really like my idea of I'm never selling. I'll write it to zero or I'll write it all the way up. I'm never going to sell it because I don't want to sit there and guess about, or things. That's one of the interesting parts. Whenever I talk about a stock, Chris, I've been on PayPal lately. And, at $320 is $360 a share. Nobody said anything great about PayPal, and I didn't own it. Now it's at 60, and the messages I get on Twitter are, Paul, do you see their operating margins are down, 17 bips? I'm like, yeah, I don't care. It's like, Paul, there's a lot of competition. I'm like, yes, there's a lot of competition, but it's 60. I'm like, I just run my discounted cash flow model, and I say, this is a good price for me. And of course, you have to really believe that, but I'm very fortunate. I've had the ability of just assuming when somebody tells me something, they're probably wrong. And that's a benefit I have. And it allows me to it's not a matter of like arrogance. It's a matter of saying, it just allows me to focus on, I have my stocks. They're going to do what they're going to do. I'm going to be wrong. I'm going to be right. And hopefully the right is a lot better than the wrong. And that's it.
Yep.
I don't know if you agree with that philosophy, but that's the way I look at it.
Yeah. I mean, and the longer you hold, the less the valuation matters. And also, sometimes people tend to think of these questions as point in time questions. Like there's only one time you can buy it and that's it. And in reality, you buy a stock and then you might buy it again, then you buy it again, then you buy it again. You might buy, stocks I've had in my portfolio, I've bought probably every year. I keep adding something to it. So over time, that sort of takes out the valuation risk too.
Look at Microsoft, my example of Microsoft. Let's say I kept Microsoft and I'm sitting on a 15, 20 bagger. If all of a sudden Microsoft fell to $100 tomorrow, even above my original price, I'd be back in the truck up saying, let's go. Like, let's get this money. And, I would be, that's the thing that you have to, like you said, you have to separate your original purchase price from the value. Because if you understand the value, it might have been a great value at 20, a bad value at 100 back when it was 20, but now at 100, it's a screaming deal that you're going to find once in a life. I don't know. I'm just saying hypothetically, it's all about, that's why the best investors understand the true difference between price and value.
Right.
Yeah. So, all right. So, guys,
I have a question here.
Oh, you have a question.
Yep, Dalton asked a question. Dalton's our analyst. So he's asking about Copart here. why were the investments Copart made able to propel them so far ahead of their competition? And then I have a follow-up after that one.
Yeah, well, it's a great case study is to look at Copart versus IAA, which was their biggest competitor. And IAA had a whole different approach. They, paid dividends. They didn't invest nearly as much as Copart for years and years. Copart would buy the land. They would buy the land for their operations. Insurance auction chose to go more of a kind of they leased the land. So I think it was in 2016 they were pretty close to equal in terms of volumes, and then since then it's like 60-40 Copart.
Wow.
So it's something that's they've just ate their lunch, and it's a part of it's just like incremental advantages that just keep accumulating over time, and then before you realize it, the game's lost and it's impossible to catch them, because not only is Copart invested however many $1 billion they've invested all during that time. So to catch up, you'd have to invest that all now, even if you could.
Mm-hmm.
But then there's advantages that come from them, increasing their network, and as that online marketplace they have, enjoys the network effects that come with that, it's extremely hard to catch.
Right.
And so I think they are uncatchable at this point unless they do something and fall on their own sword in some way. They've got the game won.
Yeah. Well, the follow-up question was about their reinvestment opportunities, and you basically answered that. So perfect.
Yeah, I think a lot of it you're going to still see them investing in land, reinvesting in land, and then the overseas businesses are still
opportunity.
That's the thing.
Yeah.
That's the thing with a lot of U.S. companies, guys. You can get a lot of compounding from the overseas growth as China gets more economically awesome. India, and I keep telling people Africa is the next frontier over the next 50, 70 years. Africa is going to have to just really, there's probably going to be a lot of growth there economically in that continent. There's 1 billion people there. That's a lot of growth potential.
And that kind of brings it back to runway and using the imagination and saying, oh, this can happen there.
Yep. Great. So guys, everybody, Chris, we really appreciate you coming on. His book is 100 Baggers. If we want to put a little clip up there, go read it, guys. I think it'll change the way in which you look at valuation also, because it really has an emphasis on future runway. And like you said, there are some companies that you could pay 70, 80 times earnings on, and it ends up being good. Doesn't mean you should go do that. It just means be aware of the compounding effect of high returns on capital. And Chris, we really appreciate your time, and we hope that if you decide to write another book, you reach out to us, because by then we'll probably have 7-figure followers, so we can probably get you 10,000 sales just from that.
Excellent. Sounds good. Compounding that way.
Yes, exactly. All right. Thanks very much, Chris. We appreciate it.
Good to be on with you guys.
All
Thanks
right.
for having me.
Thank you,
Yep.
Chris. Have a great day.
Bye-bye.